Thank you, Fred. Good afternoon, everyone. It's a great honor to be here today at the Peterson Institute, an organization that has built a great reputation for being at the very center of debate on the most important economic and political issues of the day. I want to talk this afternoon about the importance of working together on financial reform in order to create a safe and a sound financial system, a system which fosters economic growth and job creation, both here in the United States and internationally. And this is a very timely moment for that discussion. We're at a critical stage here with the financial reform bill, reform that we in Barclays have been highly engaged with and supportive of. I want to compliment the administration, the Treasury, and the Congress for the work that they've done to achieve strong, balanced, and effective reform. We're also at a critical stage in terms of economic recovery that's fragile and needs strengthening. So this is the moment for business leaders, financial institutions, and financial regulators to work together with political leaders to drive economic growth and stability. And for those on this side of the Atlantic to work with their counterparts on the other side of the Atlantic, because we live in a connected world and we need to get this right globally. As I said, the timing is critical. Over the last couple of years, we've lived through a crisis in the financial markets, followed by an economic crisis. Then in the months leading up to May this year, we've seen a recovery led by Asia, where business confidence in the first quarter this year was higher than in 2007, followed by a return to growth in the UK, in the US, and in Europe. So it seems that the enormous fiscal and monetary stimulus is working. The financial services industry has unquestionably benefited from the actions of governments and central banks around the world to mitigate the crisis. All banks, even those like Barclays, who took no government money, are grateful for that stimulus. We recognize the benefits. Importantly, we recognize the responsibilities that go with them. A responsibility first to help governments, regulators, and central banks to build a safe and a sound financial system. And a responsibility also to support clients, whether they're companies, institutional investors, or governments, to drive economic growth and job creation both here in the U.S. and globally. And just as the economy has started to recover, we seem to be facing another crisis. This time it's a fiscal crisis, with government budget deficits of record proportions in the developed economies. We've all heard a lot about Europe recently, and in particular Greece. If you look at the 2009 government deficits as a percentage of GNP, 14% in Greece, 11 to 12% in Spain, in Ireland, and in the UK, and 9% in Portugal. 10 years ago, Ireland and the UK had a surplus, and the others had deficits, but they were in the range of 1 to 4%. Today's deficits are a real concern given the high level of government debt. Debt as a percentage of GNP in both Greece and Italy was 115% last year. In the US, it grew to 83% compared to 55% 10 years ago, and it's forecast to rise still further to over 100% in 5 years' time. Over the last 3 years, we've seen the private sector in the U.S. show tremendous resilience as it's adjusted to the environment by deleveraging, restructuring, and increasing productivity. In that period, private sector employment fell 7%, but productivity grew by as much as 6% year on year. In the same time frame, U.S. government debt grew 50% to almost $12 trillion. And the employment in the public sector rose with no improvement in productivity. We now need to unwind that position. And the timing is critical once again because reduced public spending will not kick in until next year in many countries. That gives a window for private sector recovery to take a lead in driving economic growth. We've seen examples of public sector deleveraging in advance of strong growth in the past. Finland faced a difficult situation and reduced government debt sharply in the early 1990s, for example. Their economy grew by 4 to 6% in subsequent years. It was similar in Canada. It was similar here in the US in the 1980s. It was similar in Sweden. So we know that this can be done. So both Europe and the United States face extraordinarily high government debt levels, combined with demographics that make this difficult to manage. I've just come back from Asia and the Middle East, which have the highest levels of GNP growth in the world, along with some of the youngest populations. Compare that with the major economies in Europe, where almost 20% of the population is over 65, and with the US, which is not far behind at 13%. That's 2 to 3 times the proportion of people over 65 as in India and China. So how do we tackle this issue of government debt and get the economies growing? Government stimulus was critical during the crisis, but today's problems cannot be solved by increasing taxes alone. It must be managed by a reduction in public spending and by spurring private sector growth. Both the US and the UK are taking steps to tackle this issue. Chairman Bernanke has spoken consistently this year about the need to cut spending and cut deficits. And the administration has created the National Commission on Fiscal Responsibility to focus on how we can best do that. In the UK, Chancellor of the Exchequer, George Osborne, has said that tackling the deficit is the greatest economic challenge that the new government faces. He announced steps in his first budget just yesterday to reduce public sector borrowing from £150 billion this year to $20 billion in about 5 years' time. Other countries in Europe are taking similar measures. So this is the moment when we need support from the private sector most of all. The private sector can drive economic growth as long as there are banks that can help companies access funding, that can help companies manage risk, and that can help companies carry out businesses across borders. Companies and banks must work together now in support of governments to stimulate the economic growth that we need. Let me give you 3 areas where I think this is important. The first is in doing everything we can to enable businesses to access funding and to manage their risks. I'll talk about one of our clients in the pharmaceutical sector as an illustration, though this could be a client from almost any sector of the U.S. economy. We provide loans to the companies so they can invest and grow. They manufacture and they sell in multiple locations around the world. They buy raw materials in multiple locations. They trade across borders, and they have to manage risks associated with borrowing. They have to manage risks associated with foreign exchange, with raw materials, and with commodity prices. We also help them access finance through the capital markets. And since institutional investors cannot invest in a single company because the risk is far too concentrated, we also transform and structure that risk in order to diversify it for investors. The only organization that can help this client to do all these things is an integrated bank, an integrated global bank with both cash and derivatives working closely together as one business. The second area where we need to work together is in attracting new finance through the capital markets. Sensata is a global producer of controls for manufacturers in the car, aircraft, and air conditioning industries. They raised over $500 million in an IPO earlier this year, the largest IPO this year in the United States. And in order to access the widest range of investors, we talk to clients not just in the US, but in 8 other countries in Europe and Asia. And it's no different with governments. Barclays today is the #1 provider of liquidity to the governments in both the UK and the US. There is no solely domestic provider of liquidity and capital to either of these governments. All the top participants are global because you have to have scale, breadth, and global reach to do this. When the US government issues bonds, the buyers are not solely in the United States. They're in Asia, they're in Europe, they're in the Middle East. We have to make markets to manage these auctions, and in so doing, we put our capital at risk. We also have to ensure that those buyers can sell back what they want, that the market is liquid. And by the way, many buyers want their currency managed as well. If none of this happens, the result is clear. an increased cost of borrowing, and slower economic growth. Again, the only organization that can help them do this is an integrated bank, an integrated global bank running cash and derivatives businesses closely together. The third area where we have to work together is in stimulating economic growth via cross-border trade. Foreign direct investment from the private sector to the emerging economies is far larger than development aid from governments and charities. In 2007, the top 10 emerging market recipients of foreign direct investment received over $300 billion, while the top 10 recipients of development aid received just 10% of that, $30 billion. What's more, companies can only expand into emerging economies, create jobs, and provide core services if they're able to hedge their risks. This foreign trade is hugely important for the United States. This is not a one-way street. We cannot expect private sector growth at home without embracing global trade. This is no time for protectionism. The U.S. economy depends on global trade. An excellent example of this is the U.S. company Yum Brands. Yum Brands owns restaurant chains including Pizza Hut, Taco Bell, and KFC. It operates in 110 countries around the world. About 40% of its restaurants and profits are in China. It opened 500 new restaurants there last year at a time when it would have been very difficult to do that in the U.S. This is a real U.S. success story. It's become the world's largest restaurant company through its ability to trade and invest globally. Yum needs to purchase goods from 1,500 suppliers around the world in order to run 37,000 restaurants. It employs over 1 million people. It needs international payment mechanisms. It needs the ability to hedge equity risk, commodity risk, currency risk, and interest rate risk. The only organization that can help them do these things is an integrated bank, an integrated global bank that runs its cash and derivatives business as one. And by the way, Yum's shareholders are pension funds. These pension funds can only access growth in the emerging economies through this kind of company. Pension funds that people here depend on for their retirement. Pension funds that can only access this growth with the help of a global integrated bank. So we need global companies supported by global banks to foster economic growth both here in the U.S. and around the world. And we need to drive that growth now at a point where governments have to deleverage and reduce spending. The other reason this is a critical moment is because legislators and regulators around the world are now making decisions about financial reform. Let me be very, very clear. It is a myth that banks resist reform. We welcome it. Strong banks want strong regulation. And those of us who did not take government money certainly don't want to go through a similar crisis again. No taxpayer money should ever be put at risk again. So it's in everyone's interest that we have a safe and a sound financial system. And that's why banks have already made changes. Since the start of the crisis, we've been operating with more capital, with less leverage, and with stronger liquidity buffers. Barclays, for example, has increased its Tier 1 ratio from under 8% to 13%. Its equity Tier 1 from 5% to 10%. It's brought leverage down from the high 30s to the low 20s, and we've more than tripled our liquidity or cash position to over $200 billion. Barclays is not alone in taking these actions that can help create a safe and sound financial system. Banks understand that the world has changed. That's also why we've been working closely with government leaders in the US, in the UK, and Europe to help achieve sound legislation. Barclays supports the creation of an oversight authority to monitor systemic risk. We support strong consumer protection, strong corporate governance, and strong remuneration policies. We support the clear resolution authority and controls on firms that pose a risk to the system. In other words, we support most of the financial reform bill. But just like any other legislation, even in the final moments, there are areas that must be improved. Areas that will help banks extend their lending, their underwriting, and their risk management services without reducing safety and without reducing soundness. The first area is in capital. We all know that banks are going to operate with more capital, and so we're working closely with regulators to assess the aggregate impact of new capital requirements on our ability to lend, our ability to raise both debt and equity capital, our ability to hedge customer risks, and our ability to make markets liquid in the buying and selling of securities. National and international regulators are adding capital charges on certain trading books and certain asset classes at the same time as redefining what counts as capital. There are also initiatives such as Basel III that more than double the capital charges on some trading books. We have to coordinate these regulations. We have to fully understand their cumulative impact, and we have to manage the timing of implementation carefully so that banks aren't forced to reduce their lending and underwriting and damage economic recovery. Determining the appropriate level of capital for an institution calls for a real understanding of the potential consequences. And that's why this should be a regulatory issue, not a statutory issue. Establishing the right capital framework must be left to the regulators. We also have to ensure an even playing field, a level playing field on a global basis, so that we avoid the systemic risk of capital arbitrage between countries. That's why we should allow Secretary Geithner to work with partners in the G20 towards an international agreement and not be driven by national considerations. Here in the U.S., for example, the Collins Amendment proposes that trust-preferred securities no longer count as Tier 1 capital. If this is implemented in isolation, it will disadvantage not just U.S. banks, but U.S. businesses and U.S. consumers as well. U.S. banks have $150 billion of trust preferred that counts today as Tier 1 capital. Removing this could reduce credit extension by as much as $1.5 trillion. And if U.S. banks are required to hold 5% of all the assets they securitize for their clients, as the Senate bill proposes, the securitization markets could virtually close. To give you some idea of the impact this could have, over the past 14 years, about $10 trillion of consumer loans have been made available by transferring them from lenders to investors through securitization. This one measure alone could consume almost all of the sector's capital. A better solution could be for the originator of the loan to hold a proportion of it, or to let loans season before securitization. The danger if we get it wrong on capital is that we significantly increase the cost of credit, and in so doing, can damage the prospects for economic growth. The second area where we can improve legislation concerns derivatives. Let me be very, very clear. We support full transparency in reporting in derivative markets so that regulators can understand the kinds of instruments being used and know where there is excessive risk concentration. Barclays was one of the first to promote electronic trading and electronic clearing. We invested heavily in our platforms in this area, and we encourage full transparency. And exchanges have a very important role to play in providing this. So we support clearing and trading of all standard derivatives. At the same time, we have to recognize that our clients, whether they're companies, pension funds, or governments, continue to need customized derivative products. These are fundamental to their everyday business. Take one of our utility clients, for example. This is a company in a highly regulated sector, one of the first to expand into alternative energy, in this case, wind farms, and today one of the largest developers of wind farms in the world. They were able to hedge out and monetize forward energy prices to fund the significant investment in wind farms, thanks to structured over-the-counter derivatives. We must allow these transactions to take place to ensure growth, not just in the energy industry, but across all industries. And this can be done through immediate reporting and without compromising transparency or centralized clearing. And we cannot separate out derivatives businesses from banks because funding and derivatives go hand in hand. This is part of everyday business. Our cash and derivative businesses operate as one in order to help clients manage their risks. Banks working with the government to finance government-sponsored enterprises simultaneously provided interest rate swaps to manage asset liability risk. Had we not been able to provide those derivatives, they would have had fixed rate funding that wasn't hedged. And that means greater risk for the government-sponsored enterprises. It's interesting that the Lincoln Amendment proposals for the separation of banks and derivative dealers seem to find little support from the Treasury, the Federal Reserve, and the leaders on Capitol Hill. The Treasury Secretary himself says we won't make the system more stable by separating functions that are integral to banking and putting them somewhere else. And that's for a good reason. Separating out derivatives businesses will both increase the cost of capital and add risk for our clients. Similarly, the Volcker Rule aims to separate out proprietary trading activity, but banks need to use their own capital, their principal, for buying and selling securities, for raising capital on behalf of our clients, and for hedging client risks as well as their own. So we need to be careful here to define proprietary trading as trading activity with segregated capital and segregated teams of people who have no interaction with client businesses. Otherwise, regulation will have a negative impact on our clients and put the U.S. at a disadvantage in providing the most liquid, most efficient, and most low-cost markets in the world. The last area that's important concerns the model and the size of banks. A notion of regulating the model of a bank or breaking up banks that are too big to fail is simplistic. As I've said, the world in which we operate is global. The model and size of banks reflects client needs. Clients are larger. Clients are more international. Clients have more complex requirements than ever before. There's no empirical evidence that narrow banking is safer. 140 small retail banks in the U.S. collapsed last year. 78 additional institutions have been confirmed this year. By contrast, the global universal banking model, which integrates retail, commercial, and investment banking, is well diversified by business and by geography. It's well diversified by clients and by products. And it should carry less risk by virtue of diversification if it's well run. What's more, large universal banks understand the risks they're taking on better because they have broader, deeper client relationships across a wider range of services. This gives them a better understanding of their clients and of the issues that their clients face. But what's most important of all in this debate is what's required to stimulate economic growth. We need banks that can both lend and access the capital markets because that's what our clients need. We need banks that can trade derivatives because that's what our clients need. We need large global banks to support cross-border trade because that's what our clients need, as they put capital to use to stimulate trade and global economic growth. So in conclusion, we must now work together to achieve what is in everyone's best interest. Of course, banks made some very serious mistakes leading up to the financial crisis. There is no bank, and there is no banker that didn't make mistakes, and I include myself in that. But there were also mistakes in public policy, in monetary policy, and in regulation. What's important now is that we move forward together to make sure that we do the best for the future. We all have lessons to learn, and we all have one chance to get this right, because what happens in the United States is critical to what happens around the world. If we don't get it right here, it'll be much tougher to harmonize regulation across markets, and we need a global approach to avoid regulatory arbitrage. There is no industry as interconnected globally as the banking and finance industry. And while the US, the UK, and the European Union all have their own paths, their own processes, and their own timetables to follow, for the first time, the G20 offers a foundation upon which to build a global regulatory framework. And the goal must be globally coordinated regulation. So what does this mean for all of us here today? The reforms being debated as we speak is a strong bill. But the improvements I've talked about this afternoon are critical to getting it right. We have to work together on an international basis to ensure a safe and a sound financial system. a system which firstly enables banks to lend and raise capital at an affordable price. Secondly, enables banks to deliver the services clients need to manage risk. Thirdly, enables banks to support clients on a global basis, whether those clients are companies, financial institutions, endowments, or governments. These things are vital if we're to generate business and economic growth for the benefit of all. Thank you very much for your time.